everybody. Welcome to today's fundamentals. Hello, Peter.
Hello.
What's up in the FX market?
Well, we had a US dollar which was slightly up. There were some conflicting fundamentals. On the one hand, we had better than expected data. Say, for example, we had the consumer confidence indicator which came in higher than expected for June, while at the same time we had the number of new home sales practically also being on the rise. They're expected to drop. So that was a positive, which tended to ease market worries a little bit. It was characteristic that there may have been some safe haven inflows. On the other hand, though, the data as such tend to suggest that more or less the Fed's going to have to continue on its hawkish stance and more or less strengthen the possibility of another rate hike. And that tended to support the USD and at the same time weigh on the market sentiment. The US dollar edged a bit higher, but not convincingly enough. More or less seems to remain in a sideways motion.
Weren't also Canada CPI rates you out yesterday?
Yep, we had Canada CPI rates out yesterday. They slowed down more than expected. And more or less that tended to weaken the Canadian dollar, as that would more or less imply that BOC may ease on its hawkishness. However, I would be noting here that we had also a drop of oil prices, which may have weighed on the Canadian dollar as well, given that the Canadian economy is a major oil producing one. Hence, any drop of oil prices tends to weigh on the exports.
And how about the Australian dollar?
The Australian dollar had already bearish tendencies against the USD, but I would say that they intensified during today's Asian session, as we had the release of Australia CPI rates. They were from May. More or less, they slowed down considerably, and that weighed on the Aussie, as that would or could ease the hawkish stance of RBA. I would be noting at the same time, though, that there are a number of fundamental factors which tend to weigh on the Aussie, and the one would be, say, for example, the headwinds of the Chinese economy as it tries to rebound, and that does not seem to be working well right now. I would be also noting a market sentiment which has considerable considerations whether there's going to be a global economic slowdown, and hence that could also weigh on the Aussie, given that it's a commodity currency directly linked with economic activity on a global scale.
And is the Turkish lira still weakening?
Actually, no. Yes and no, in the following sense. If we're talking about the strict movement of the Turkish lira, it seems that there is a stabilization in place near 26 Turkish liras per dollar. On the other hand, though, the bearish sentiment is still present, and I wouldn't be surprised to see the Turkish lira once again starting to weaken. For the time being, though, it's as if the market maintains a wait-and-see position after the less than expected rate hike by CBT last week, and I would like to see what measures are going to be announced by the Turkish government.
And what about the European theater?
The European theater, specifically the euro, was primarily affected yesterday by two events. The first was the release of German CIFO indicators. Now, the indicators showed that there is a wider pessimism about the outlook of the German economy. At the same time, though, they also implied that practically the actual conditions on the ground for the German economy are deteriorating. Both of them tended to weigh on the common currency somewhat, especially during the European session. But afterwards, we had some statements from ECB President Lagarde, where she practically stated that inflationary pressures are still too high for the Eurozone, and that foreshadowed more monetary policy tightening ahead, which tended to support the euro. It was characteristic, not how the euro strengthened against the US dollar, but especially against, say, for example, the Australian dollar, where we had conflicting fundamentals, on the one hand supporting the euro, on the other hand weighing on the Aussie. I would expect that most probably the hawkish stance of the ECB may continue to feed some support for the euro for the time being.
And how has gold's price been reacting?
There were some, I would say, bearish tendencies for gold's price, and that was mostly, I would say, a result of the strengthening of the USD given the negative correlation between the US dollar and gold. I would expect those bearish tendencies for the time being to be maintained as long as the Fed's hawkishness continues to feed the USD.
And how about oil prices?
Oil prices edged lower yesterday, and that happened despite the AP crude oil inventories figure showing another drawdown, which implied that oil prices may have not been affected so much by the conditions of the US oil market, but more about demand outlook wars, which tend to weigh on oil prices in the sense that lesser demand is expected given the expected slowdown of economic activity. And I would be highlighting actually today the release of the EIA crude oil inventories figure. Another considerable drawdown, and should be even wider than last week's. That may, I wouldn't say turn the tide, but still hold the drop of oil prices. It's going to be an interesting release.
And how about US stock markets?
US stock markets gained mostly on the positive market sentiment, especially given the better than expected US data. There may have been some hesitation as we had the mutiny in Russia, but I think that has been overcome by now. And mostly US stock markets are trying to navigate through A, the economic circumstances in the US, B, I would be saying the Fed stance, and I would be also noting C, the earnings season, which is about to begin next week.
And what else in today's calendar?
Well, we already had Germany's GfK consumer sentiment. That tended to be a little bit worse than expected. I wouldn't say that it had a major effect on the euro, but still it's a clear indication on where Germany is heading to. I would be also noting that we had France's consumer sentiment that was a little bit better. Right about now, we should be getting from Italy the preliminary HSEP rate. And it's not going to be so interesting due to the size of the Italian economy, which, okay, it's considerable, but not as critical as France or Germany, for example. But the main issue here is the message that the release is going to be sending. Should the HSEP rate slow down, that may weaken the euro, as that would imply practically or foreshadow more slowdowns from, say, for example, Germany's and France's HSEP rates, which are due out tomorrow and on Friday. Other than that, I would be highlighting the ECB forum, the annual forum, which is being made in Sintra, Portugal. We have a number of speakers. We have Fed Chairman Powell, we have BOE Governor Bailey, we have BOJ Weather, I think, and ECB's Lagarde. All speakers are expected to be hawkish, maybe with the exception of BOJ Weather, given that BOJ has maintained a rather ultra-loose monetary policy. Overall, though, the message is expected that more rate hikes are to come and inflation is too high, and that could more or less intensify market worries for a global economic slowdown, which in turn may support safe havens while weighing on riskier assets, say, for example, stocks or even commodity currencies.
Great. Thank you, Peter, for your time, and everyone for watching. Join us after a short break for technical analysis with Peter Iosif.
So, welcome to the technical analysis part of the presentation for today. My name is Peter Yusuf, Senior Market Analyst at IronFX. In front of your screens, you have the US dollar index. It's the 4-hour chart. All charts to be presented are to be of the same time frame. Interestingly enough, please note how the US dollar index remained in a rather sideways motion despite some edging higher during the Asian session today, while today in the European session it remains relatively unchanged. Let's also add the relative labels. 104.60 red. And the new one, R2 at 103.45. Okay. And the R1 102.55. Let's go now to the support lines. S1 101.60. Both of that. The S2 now at 100.80. Let's reaffirm this. Yep. And the S3 at 99.8. That should be it. So, what do we see? There are two elements which tend to support the idea of a sideways motion. The first element would be the fact that the price action was able to rise and break above the downward trend line guiding the index. You can see it right here. On the flip side, we have to note here that it has more or less respected. There was a slight break of the 102.55, yet the price action came in lower afterwards. I would be also highlighting the fact that the RSI indicator is near the reading of 50. It's actually at 51.3 right now, implying a rather indecisive market, which may allow the sideways motion to continue. So for the time being, we expect the price action of the index to remain between the 102.55 and the 101.60. There seems to be a rather low volatility, maybe with some slight exceptions, but over the past 48 hours, nothing much. Maybe some slight bearish tendencies and stabilization, nada. Should the bulls take over, I would expect to see the US dollar index breaking clearly the 102.55 and start aiming for the 103.45. On the flip side, should the bears take over, we may see the price action dropping, breaking the S100 and 160. For a bearish outlook, mind you, I would require a lower true than this and this. And it's characteristic how the level was tested 2 times and held its ground practically. Nevertheless, should the S1 be broken, I would start adopting, clearly be broken, I would start adopting a bearish outlook and expect the price action to start aiming for the 100.80. Note how it has provided support here and here. Pretty well. Okay, let's have a look at Euro USD. Let's clean up a little bit the chart here. Give me a sec. Let's shift this a little bit to the right, like this. That's better. Let's also place some labels in red. R1 at 1.1080. Let's also mark the R2. 1.10. Let's have a look at that again. 25. Next one to be set on the 1.0965. The S1 first support line being placed at 1.0910. S2 1.0845. And the S3 1.0785. That's it. For the time being, we tend to maintain a bullish outlook given that the price action, okay, corrected low after hitting on the first resistance line, the 1.0965, but see how it has respected the upward trend line. And the RSI indicator on the other hand is slightly above the reading of 50 at 58. That's not so bullish. Nevertheless, as long as the upward trend line remains intact, we tend to maintain our bullish outlook for the pair. And should that be dominant, we may see the pair rising, breaking above the R1 1.0965, and start aiming for the R2 1.1025. For the time being, though, it's a battle. And it's a battle between the R1, the resistance line, and the upward trend line. So should the R1 be the winner, though, and hold its ground, then we may see the pair stabilizing, remaining below the R1, yet breaking the upward trend line, which would be a clear signal, in our opinion, that the upward trend line or the upward movement has been interrupted. For a bearish outlook, I would require far more. I would require the pair to drop, break the upward trend line, as mentioned before, signaling the interruption of the upward movement. But I would also like to see the pair breaking below the 1.0910, the support line, which provides support numerous times here. So that's pretty valid. And start aiming for the 1.0845, a level which has provided support here. That would allow us to draw a nice downward trend line, showing us also the limitations of the downward movement. That should be it. Let's have a look on cable on technical level. Oh, it's dropping. Okay, definitely we have to add labels here. R3 at 1.2940. In red. Set. Let's have a look at the R2 at 1.2845. Let's have a look at the R3. Sorry, R1. First resistance line 1.2775. First support line at 1.2695. That's almost 1.27. S2 at 1.2595. And finally the S3 1.2485. Verify the levels once again. Okay. 2595, yeah. It's almost as if we have equal distances of around 100 pips. Okay. Yeah, but they're pretty valid, both of them. So we can see the validity of the S1 as it has supported the downward motion of the pair and practically held it afloat above the 1.2695, so that's valid. On the other hand, we can see how it has provided resistance a couple of times here at the 1.2775, even higher the peak, and aimed for again here at 1.2845. If we go lower and we check the S2, then we have 1.2595, which provided resistance here. So practically that's more like a resistance line, which now has turned its role into support line. While even lower, we note the 1.2485, which was the level at which this downward movement was ended and then reversed to an upward motion. Now let's clean up a little bit the trend lines. No channel. Okay, there was a downward movement. Yes, there was. It was interrupted though. And practically we're now talking about a sideways motion, more or less, even a little bit here. Yeah, more or less between the 1.2775 and the 1.2695. Behold, though, we have some slight bearish tendencies implied by the RSI indicator, which has dropped to the reading of 43. So that's a risk which we should bear in mind. For the time being, though, the sideways motion is being maintained, and for a bearish outlook, I would require a clear break of the S1 1.2695 and the price action to start aiming for the 1.2595, nothing less. Bearish bullish tendencies seem not to be on the horizon. Okay, let's have a look at USDJPY. Nice upward movement being maintained. Let's extend, and that's clearer now. You can see that the price action of USDJPY was initially on an upward movement. That was up until the last days of May, around the 26th of May, yet then maintained a sideways motion up until the midst of June, and from there on we have a clear upward motion once again. It's very, very characteristic in my opinion, and I think that we should maintain the bullish outlook. Let's see how high it can go. For the time being, definitely this has to be turned into a support line, given that the price action has moved above it. Let's go hunting to see if find a new resistance line. I would be placing this peak here. It could go even as high as this one. I think this one's better, because you have a peak here and multiple peaks here, and we're talking about October last year. Once again though, I would not reject this peak here. Once, twice. Let's keep it this one, and that would be the, in red, 149.35, 40 maybe. Locking it in, readjusting the chart. Let's place the labels. R3 at 149.40 in red. Second resistance line being placed 147.30. First resistance line at 145.70. First support line being placed at 143.85. That definitely has to go in green, so we get a visual effect. And here it is. Second support line being placed at 142.10. And there's 3 at 140.75. Okay, once again, for the time being, we tend to maintain a bullish outlook, and I expect the pair to continue higher, start aiming for 145.70. We can see the direction. On the flip side, for a bearish outlook, I would require the pair to drop, break the 143.85, break most certainly the upward trend line guiding the pair, and even touch the 142.10. It has to touch it, nothing less. The RSI indicator is below the reading of 70 for the time being. And actually it's at 66. Okay, 66 and a half. That's quite, I wouldn't say bullish, but still, yeah, it shows a bullish predisposition for the pair. Let's have a look at safe haven currency pair USD-CHF. Clear sideways motion. Nothing much here. But we have to note here that the range is pretty wide. Could be narrowed a bit. Let's have a look at the Aussie. Nice downward trend line. Definitely this has to be turned down to a resistance line, given that the price action is below it. Let's mirror it. And let's go hunting for a new ultimate resistance level, support level. Unlocking the chart, going back, way back. Here you go. I would be noting this peak here. It's a little bit narrow, I know it, but still it's quite valid in my opinion. And that would be in green, the 0.6365. Readjusting the chart. Okay, let's place some labels here. Starting with the R3 at 0.69. Sorry, that should be in red. Second one at 0.68. And a little bit off course, the first resistance line, quite lower than the S2. And that would be the 0.6660. Probably we have made a mistake here. It's not support lines, it's resistance lines. And the first resistance line here, sorry, my bad. Support lines in S1 0.6575 green. S2 0.64. And the S3 0.6365. That's it. For the time being, we tend to maintain a bias for the downward motion to be maintained. And most probably, I wouldn't be surprised to see the price action of AUD USD intensifying its bearish intentions and touch, if not even break, the S1 0.6575. It's characteristic how the RSI indicator has reached and bounced slightly on the reading of 30. It's actually right now at 34. While this upward candlestick, the green candlestick, the last one, in my opinion, is a mere correction low before the price action descends way lower. It's characteristic that I wouldn't say consolidation, but still the correction higher was made after the price action has broken the lower Bollinger Band. The stabilization should allow for more space to be created between the lower Bollinger Band and the price action as such, which in turn may allow the price action to start dropping considerably lower. On the other hand, note how the Bollinger Bands have narrowed, once again implying low volatility for the pair. Okay, let's have a look at USD CAD. It should be in the reverse here. And it is. Okay, let's place some labels. Starting with the R3 at 1.3385. At the R1, sorry, at 1.3315. At the R1, 3230. The first support line being placed at 1.3135, green. $1.3065 is the second support line. And the final support line being placed at 1.2975. Let's zoom a little bit out. I think we get here a very, very clear picture. It's characteristic how the price action was on the rise for the past 48 hours, more or less signaling the end of, or at least interruption, of the downward trend line guiding the pair. So we have a downward movement which has stopped, or at least has been halted for now. On the flip side, please note how the price action has respected for the time being the 1.3230. That tends to imply more or less a sideways motion. Note though at the same time the RSI indicator. It's, I wouldn't say very high, but still it's at 59.9, almost 60, which tends to imply some bullish tendencies. Should that be more evident in the coming American session, we may see USD CAD rising, breaking the 1.3230. Definitely I would require a higher peak than this one. So it has to break above the R1 and start aiming for the 1.3315. On the other hand, the sideways motion could play out between the R1 and the S1, the sideways movement. While even lower, should the best take over once again, I would require the pair to drop, break the S1, 1.3135. I would require lower drill than this one, and start aiming for the S2, 1.3065. Mind you that the difference between the S1 and the S2 is a little bit narrow, but still pretty valid. So I'm keeping that. I'm not so much cared about symmetry right now. Actually, I never was. But now, who cares? I would expect, should we see a downward movement and a clear bearish outlook, the price action to break it below the S1 and actually start aiming, if not even reach the S2 1.3065. That would allow us to start drawing a clear-cut downward trend line, marking the limitations of the downward movement. For the time being, though, once again, chances are for a sideways movement, maybe with some bullish tendencies, allowing the pair to rise, break above the R1 1.3230 and start aiming for the R2 1.3315. Okay, let's have a look at XAU USD. On the one hand, here we have some slight bearish tendencies. Note how the price action is once again hitting on the 1910 support line. On the flip side, though, we have to see that the level has held its ground once, twice, 3 times. So it seems to be pretty solid. For a bearish outlook, I would require the price action to clearly break the S1 1910 before moving lower to the 1885, which is the next support level. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
Hi everyone, welcome to another IronFX live TV video. In this video, I'm going to talk about swap or rollover. So, what is a swap? Swap is the interest paid when the market rolls over. Every day the Forex market rolls over, which means your trade is carried from one day into the next. So basically a swap refers to the interest earned paid for keeping a position open overnight. If you're paid swap, the cash amount will be added to your balance. If you're charged swap, the amount will be deducted from your balance. Swap charges are usually small but can add up over time. There are 2 swap types, swap long for long positions and swap short for short positions. Both types are expressed in pips per lot and vary depending on the financial instrument that you're trading. One way of profiting from swap rates is the carry trade. This involves buying a currency with a high interest rate while selling a currency with a low interest rate. You will earn a profit on the net interest of the difference. If you close your positions before the end of the trading day, which is known as the rollover point, you will not owe any charges or earn any swap interest. The interest rates for different foreign currencies are based on decisions taken by the central banks. The amount credited or charged to the trader can also depend on a number of factors, such as the difference between the interest rate of currencies, the Forex broker's commission rates, the day when you open the position, or the price movements of the currencies. Thank you for watching.
Okay, I think we're ready to kick off. All right, okay. So today's webinar series by IronFX is about fundamental trading strategy. So once again, the information in this webinar is purely for informational and educational purposes. Please do not construe it as investment advice or investment recommendation. And please do all due diligence prior to putting on any trades across any asset class, right? Okay. So the full risk warning and disclaimer is here on this page. Okay, so this webinar is brought you together in partnership with EFG Everest Fortune Group. We're the finalists for best FX research from 2019 to through 2021, best equity research in 2020 and 2021. So I'm your host today, Ketan, and let's start things off. Okay, so over here we have a slide on the data links for where we can get fundamental information about the United States. All right, feel free to take a screenshot of this, but also not to worry, all these other links here can be found on Forex Factory. So basically, you guys just need to know and remember Forex Factory. And once you're on that site and you search for the economic calendar, and I will also teach you how to search for the respective economic news events. And from there, we are able to find all the sublinks. Okay. Right. So do not worry. You can take a screenshot. Feel free. But the main link to look out for is Forex Factory. Right. Okay. So let's go and go into Google. All right. Okay. So here we have Forex Factory. Right. Okay. Just a quick note. You guys able to see the page Forex Factory? Yes. Just maybe a quick show of hands to see that you're able to view that page. Right. Okay, wait, hang on. Yeah. All right, guys. Sorry. Okay, I assume everyone can see my Forex Factory page, right? Okay. So if that's the case, let's continue. Okay. Right. Okay, so here we have Forex Factory. Depending on your time zone, it will give you the time. Okay, today is now. Okay, I've not refreshed the page, so let me refresh the page. Hang on. Okay. Yep. Okay. So this is 6:05 p.m. UTC +8. So this is Singapore time. Today's date is 12th of April. Right? Okay. So now let's just start. Okay, we're going to look at US fundamental data. Okay, so Forex Factory is a good website, and with its economic calendar, which is on the home page, right? So if you come to Forex Factory, I just do a Google search, Forex Factory, right? It will take you to, oops, sorry, hang on. Wait. Yeah, okay, yeah. So if you do that, yeah, you search for Forex Factory, it'll come here, right? And on the home page, okay, let's just refresh the home page. Okay, if you click on home, it'll bring you to the main page here, and this is the economic calendar right here. Okay, so what we're going to do is we're going to look through, for example, let's just start quickly uh, through the month of March. Okay, so we had the FOMC meeting, right? The Federal Reserve had its interest rate meeting in the second last week of March, right? So 22nd and 23rd of March was the meeting. So let's start the calendar from 20th of March till the present date. Okay. And let's just filter to look only for US related events. Okay, so we'll cover the the events that will have the most impact, right? And we'll cover all the event types and just US. Right. Okay, so this brings us to our starting date, March 20th. And we have a list of various economic events for the US. Okay, so because we are looking at foreign exchange FX, we'll be looking at what central banks are doing. So the FOMC is a big event led by the Federal Reserve, which is the largest and most influential reserve central bank in the world, right? Okay, so let's quickly look at that. So we have this event here, March 23rd. 6 or 7 this is obviously UTC time, so this, because we're UTC plus 8, this will show us as Thursday, March 23. Okay. Now, if we look at the we have the federal funds rate. All right. So if you click on this folder here, it tells us the source of the data and the links and the description. Okay. So I think you guys should be pretty familiar with this. And also, if we click on the graph here, it will tell us the history of the interest rates as well. So how the Fed raised interest rates in 2016 all the way till early 2019 before cutting them and bringing them down to zero because of oh, sorry, not zero, but very close to zero, because due to COVID. And then after that, in order to combat inflation, they started uh, raising interest rates very aggressively. This is this period has been one of the fastest, or if not the fastest, rate of interest rate hikes, which has caught many people off, even though the Fed did forewarn markets that they would uh, aggressively raise interest rates to combat inflation. Okay, so now we have this here. Okay, so if we click on the folder, we click on latest release, it takes us to the Federal Open Market Committee website, right? Uh, so that's what FOMC stands for, Federal Open Market Committee. Over here, we are able to find out the calendar meetings for 2023. And as you can see, the next meeting, or the third meeting for this year, will run from 2nd to 3rd May. So from now till then, we've got about uh let's see, what, 3 weeks. Yes, 3 weeks, about 3 weeks before the next meeting comes up, and all eyes will be on Chairman Jerome Powell. And also we are able to view uh the statements, the historical statements and press conference. So if I click on PDF, you are able to read the full press statement in detail, as well as view the press conference as well. So there's a YouTube video here, which you can, if you choose to, you can read through it as well to determine exactly what uh, uh, the chair, Jerome Powell, was saying. Because his impact, his words during the FOMC meeting can have a meaningful impact on markets moving forward. Right? If he's sounding very hawkish or dovish during the meeting, it can have a meaningful impact on currencies. Right? So when we say hawkish, it means him and his other committee members are looking to further increase interest rates. And if it's dovish, it means he could be pausing interest rates or uh, cutting them. Okay. So we have the FOMC website here. So one of the things to look at is what central banks are doing, and when are the meeting and when are the upcoming meetings. So the Fed is the biggest central bank, and it's important to see how they are raising interest rates. So as you can see here, we have now reached 5% after the last meeting in March. Okay. Another thing to look out for would be, right, as we scroll down, there's also other economic data. Something that we would also need to see is GDP numbers, right? So if the US economy is strong, GDP is strong, we can expect the Fed to still continue raising interest rates if they need to do so, right? If the economy is stalling, we have negative growth or negative quarterly growth of GDP, then something is wrong, right, with the economy, and the Fed is very likely to pause or even cut interest rates, right? Which would further weaken the dollar, weaken bond yields, and drive the dollar index lower against its major currency pairs. Okay, so if we look at GDP here, so you can see GDP after the COVID lockdowns, GDP rebounded strongly in December 2020. I believe this should be the fourth quarter of 2020 or the third quarter, this result. And then uh, it's been growing pretty steadily. And then first half of 2022. Okay, so this is Q1, Q2, sorry. Okay, although this is saying here June and September, but this is actually the GDP data for Q1 and Q2 of 2020, where we had two periods of shallow negative growth, which constitutes a technical recession, right? And and then followed by a strong rebound in the second half of 2022, where growth bounced back to about, what is it here? Let me see. Okay, 3.2% and 2.6%. So we have strong growth uh, to end 2022. All right, okay. Okay, so now we shall close the graph. And if we click on the folder, right, it'll show us that the source for this piece of information is the Bureau of Economic Analysis. If we click on latest release, it'll also take us here. So you can see the latest GDP data was announced on 31st March. And you can find out more details. Oh, wait, sorry. This is by state. It should be this one here. Sorry, on the 30th of March. Okay, so you can give us more details and information regarding the state of the economy. So after looking at what central banks do, we look at GDP numbers as well. The next piece of information to look out for would also be ISM manufacturing numbers, right? PMI numbers for services sector and manufacturing sector, right? Because GDP is announced on a quarterly basis, although you do have updates along the way, they are not as regular. The data is not as regular as other agencies. So if you look at ISM PMI manufacturing, and we click on it, ISM stands for Institute for Supply Management. Click on latest release. It takes us to their website. Okay, so accept cookies. So we have PMI reports, purchasing managers index reports for the manufacturing, services sector, and hospital. Hospital was something relatively new that came up just after COVID, but we will look at more on manufacturing and services. So if you click on view charts for both manufacturing and services, right? Are you okay? It takes us to shows us the overall state of the economy on a monthly basis. This is for the manufacturing economy, manufacturing sector, where we can see manufacturing has actually been contracting since the third or fourth quarter of last year and is still in a contraction zone. So any reading below 50 means that this sector is contracting, and any reading above 50 means this sector is expanding, right? And here you have the sub indices as well: new orders, production, employment, inventories, prices. So one of the reasons for, okay, so similarly, this is for services sector. Services are still expanding pretty steadily, although the latest result dropped to 51.2, but it's still in expansion territory. So you can see the US economy is being held up by the services sector, right? And also let's open this up. Okay, so you can see there's similarly for both manufacturing and services sector, there are sub indices such as new orders, employment, prices, imports, exports. So what I'm going to zoom in on here is the prices indices, right? Because the main reason central banks are raising interest rates is due to inflation, right? Rising inflation. And in order to combat inflation, the Fed can only do one thing, and that is to raise interest rates, make lending more expensive for corporates, for retail, for households, right? They have a very blunt tool, and that's the one of the primary tools that they can use to try and combat inflation. Okay, so why is prices important here? The prices sub-index for both manufacturing and services, right? So if we scroll further down, right, so you can see throughout from early 2021, the prices index for the manufacturing sector was already at pretty high levels, right? It was almost, this looks at, yeah, almost 90, right? Almost 80 plus onwards. So the prices indices were already elevated throughout 2021, which should have uh, signal to the Fed that probably was already time to raise interest rates in 2021 instead of waiting all the way till the start of 2022. So the prices indices for the manufacturing was elevated. Similarly, we should see something similar for the services sector as well. The services sector prices were also increasing pretty rapidly and remained constant throughout 2021, 2022 until the middle of 2022, where it has been descending pretty steadily as interest rates were raised. So similarly, for the manufacturing sector as well, the prices indices were also dropping. So what this means to say that is the rising interest rates by central banks, especially the Fed, made borrowing expensive uh, for corporates, for manufacturers, and all other participants. And when things become more expensive, generally demand pulls off. So as demand pulls off, price will start to recalibrate and probably uh, trend lower. So as demand pulls back, prices for in the manufacturing sector and services sector started pulling back. So you could see the effect of um, inflation or the effect of rising interest rates on the prices indices of the services and manufacturing sector. So this is important because this also relates to the overall CPI numbers, right? Inflation data. So as prices fall, CPI falls, the job of high interest rates or the tool of high interest rates is helped to slow down inflation. So if you look at annualized inflation, right? And speaking of inflation, that is the number that is coming out today, right? 8:30 p.m. UTC plus 8 is where the Fed, sorry, not the Fed, the Bureau of Labor Statistics, BLS, will announce their inflation figures for the month of March, right? So just before we jump into inflation, we can also look at sorry, where is it? Non-farm employment change, okay, and the unemployment rate. So another important fundamental factor to look out for the US is the employment reports. So this is the non-farm employment change and unemployment rate. So similarly, if you were to click on latest release, right, it takes you to this page. So basically, Forex Factory is the primary website that you need to remember because all the other sublinks can be found on their website. So it takes you to, so we clicked on employment non-farm change. So it takes us to this page. Okay, it's always easy to visualize data or information through a chart. So if you scroll right to the bottom, you will see a link for news release charts. Okay, so let's just click on that. Okay, so the first chart that it shows us is the civilian unemployment rate. So as you can see, after spiking as high as 14.7% in April of 2020, as economies reopen, uh, companies started hiring again. The unemployment rate fell pretty sharply and steadily, and it's been hovering between 3.4 and 3.7% for the past, nearly a year now, right? So despite uh, the tech layoffs that we've been hearing about a lot, unemployment rates are still historically low. And this tells us that the tech sector is just one uh, industry in a wide range of other companies, right? So it may not be uh, the tech layoffs, although they are high in absolute numbers and in relative numbers to the size of the company, it's not representative. It's not representative of the entire American workforce, right? So you can see unemployment rates have been pretty low. So this tells us, together with uh, non-farm payments. Okay, so non-farm would be, yes, here, employment by industry, I believe. So click on employment by industry, click on go. Yep. So this gives us total non-farm figures, right? So if we just take out private is just a subset of non-farm, so we shall just look at total non-farm. So as you can see, after the huge drop uh, in the workforce, right, the workforce numbers, they have they have surpassed the pre-COVID highs and are making all-time highs here. So basically, what you're seeing for the month of March, there are a total of 155 million Americans currently employed. So by looking at unemployment levels, which is the total non-farm figures, and the unemployment rate, it tells us that the workforce is strong, the labor market is tight, so the Fed can still continue to raise interest rates if they wish to do so, right? Because if unemployment rates are rising drastically, non-farm numbers are dropping, it tells us that more people as a whole are being laid off, and this is a scenario where the Fed may actually start to pause or even start to cut interest rates. So this is another economic data point that is worth monitoring and to understand the rationale behind the Fed's movement, right? Or the Fed's actions rather. Okay. So next, okay. So before we go into the last one, which is CPI. So we've looked just to quickly cover or to review. We've looked at the FOMC events where the Federal Reserve raised interest rates. It's important to know how much they're raising interest rates. And it's also important to look at their statements and the press conference to see how hawkish or dovish the committee members are. They would also look at GDP numbers to see the actual overall strength of the US economy. And but because GDP numbers are released on a quarterly basis, right? They do not give us timely information, whereas other agencies or information sources such as the manufacturing and services PMI numbers give us a monthly update. And then we can also look at non-farm employment change and unemployment rate, which finally brings us to another important fundamental indicator, which is CPI or inflation. All right, so if we click on CPI in the folder here and click on latest release, again, it takes us to the BLS page where we have tables and text, and the easiest way to visualize whether inflation is rising or falling is by looking at the charts. So we'll scroll down and look at news release charts. Okay, so if you look at the charts here and you click on 12 months percentage change over the past 20 years, click go. You can see the historical performance of inflation on an annualized basis. So we are looking at all items here. And if you look at all items less food and energy, right, although the color scheme is not so great, we have dark red or brown and we have a lighter shade of red here. So you can see both headline inflation and core inflation have been rising. And after headline inflation peaked June of in June at 9.1%, it's been falling pretty steadily, whereas core inflation, which doesn't include food and energy, has taken a longer time to pull back. So as you can see, the latest readings here are for the months of are for the month of February, and the next data point will be March, and that data is being released today at 8:30 p.m. UTC +8. So if headline inflation on an annualized basis drops to lower than 6%, and for core drops to lower than 5.5%, that means naturally inflation is falling, is continuing to fall, and that bodes well for the Fed because it makes their job easier. So it's very likely that moving forward in May, they may not consider hiking interest rates because if inflation is continuing to fall, then for them to keep interest rates at 5% is probably the next best thing to do. So what this means that markets will anticipate that the dollar will weaken and bond yields will fall. Now, why this is happening? Because when markets are expecting the Federal Reserve to be less hawkish, the dollar will fall and the bond yields will also fall. So if you look at this chart here, when inflation peaked in the middle of June 2022, it's about the same time where the dollar index also peaked and bond yields also peaked. So now with that, we shall look at the charts, okay? All right, so this is the DXY chart. Let's just go to a weekly chart so it's easier to visualize what is actually happening. Okay, so as interest rates were being raised aggressively by all central banks, particularly the Federal Reserve, the dollar index was also rising. It went from 95 to all the way to about 115 in within 6 months. And similarly, let's just do a dual chart so it's easy to. Okay, right. Okay, so this is a dual chart here. So what I'll do is for this, I'll switch everything to weekly. The first chart, I'll put the DXY. Okay, and this chart below, I shall put the US 10-year bond yield. Okay, so this is a nominal United States 10-year government bond yields, which is a good indicator of where of what the market expects in terms of interest rates. Okay, so as you can see, at the start of 2022, the Federal Reserve was raising interest rates aggressively due to rising inflation. Bond yields were rising from about 1.5% all the way till to the middle of to June to about 3.5%. And similarly, the dollar index also rose from 95 all the way to July, June, July, hitting about 110. And after a slight pullback, the Federal Reserve was still raising rates, and bond yields and the dollar index made new highs. So this is important because as inflation is rising, the Fed has only one tool or a couple of tools in their toolbox to combat inflation, and that is to raise. One of them is to raise interest rates, and the other is to reduce the balance sheet. These are the two primary tools that they have, or these are the two main ones that's easier to understand for all of us. So in this period, when you have rising bond yields, rising dollar index, naturally, it means all the major currency pairs, your Aussie, your Euro, your Pound, your Kiwi, your CAD, your Swiss franc, and your Yen, they're all going to weaken considerably against the dollar. So this is a period where you would be looking to long the US dollar for most periods, right? Of course, there are pullbacks along the way because this is, mind you, this is a weekly chart. Definitely there'll be retracements along the way, but you can see the general trend was strength in the dollar, right? So when you have strength in the dollar like this, you'd be looking to go long at any pullback in the dollar, in the strength of the dollar. And as we know, inflation peaked around June, July, and that's when market expectations also reversed, despite the Federal Reserve raising interest rates and keeping them high. Bond yields actually started to pull back and range between 3.4% and about 4%. In that same period, the dollar index has dropped significantly, right? You would think that with the Fed keeping interest rates at this, which was at this time maybe about 4.5% and raising it to 4.75 and now finally 5, you would think that the dollar would still remain strong. But no, in fact, actually the dollar has sold off very significantly, or very significantly, while bond yields have more or less stayed within 3.5 and 4%. So what this tells us is markets are expecting the Federal Reserve to eventually pause and cut rates. So basically, from this point onwards, in the third quarter or fourth quarter of last year, the dollar, naturally, as the dollar index falls, all the other currency pairs have gained against it. Right. So despite the Federal Reserve keeping interest rates high, the dollar has actually weakened. So if we just quickly look at, okay, so just keep the top one as the dollar index. I will switch the bottom one to Aussie. So similarly, as you can see that with the crosshairs, right? This is a weekly chart. So as the dollar index fell, despite the Federal Reserve raising rates, the Aussie gained, right? Because the Aussies were still, the Australian Central Bank, Reserve Bank of Australia was still increasing rates. Federal Reserve was still increasing rates, but the dollar was actually selling off. And so it's important to notice uh, these changes in price points. And now you can see that we were in a period of downtrend for the dollar from October all the way till uh, end of January this year, before it pulled back up again, retraced higher, and then finally coming back down again. So similarly, if you were to look at, oh, wait, hang on, let me keep this as DXY, top chart DXY, bottom chart, switch to Euro. So similarly, it tells the same story again. With dollar index falling, the Euro started rising significantly, right? Similarly for pound, same story here. Kiwi, also you see a similar story. And let's just look at the last one, which is the dollar yen, right? Okay, dollar yen is a very interesting example because you have two very divergent central banks. You have the Federal Reserve, which was actively raising interest rates, and not only actively, aggressively raising interest rates from the start of 2022, whereas the BOJ or Bank of Japan have been in a perpetually in a negative interest rate environment. So there's a big divergence in monetary policy between the two central banks as of 2022. Fed was increasing rates aggressively, going as high as 5%, whereas the BOJ kept interest rates at negative 0.1%. So you would think that with this monetary policy in place by the respective banks, you would think that dollar yen would continue to shoot higher. But no, actually, in fact, the dollar yen peaked at the same time as dollar index. And it's basically a mirror image of the dollar index, right? So this is because the yield differential between the US and Japan started to fall. So now I'll show you how we can use TradingView to help us chart the yield differential. Okay. So the yield differentials between countries, and we will actually help us determine the general trend in the currency pair, and also potential turning points, and also identify long-term trends. So once you know where the turning points, where the long-term trends, you're able to zoom in on daily charts, for 4 hourly charts or hourly charts, and uh, use your appropriate or your preferred trading strategy and style. Okay, so what we're going to do is, on the top chart, we'll change it to the US 10-year yield. So just type US 10Y, right? So this is the United States 10-year government bond yields. Okay, so that's the top chart. Bottom chart, we're going to change it to Japan. So that's JP, I believe 10Y. Yes, okay, so JP 10Y. So that's the Japan 10-year government bond yields. Okay, so right now, you can see with respect to bond yields, the dollar for the US dollar from the start of 2022, it was about 1.6, 1.7, was rising steadily throughout the year, peaking at about 1.43%. So this is for the US 10-year. And similarly, for the Japanese yield, 10-year yield, it was relatively stable at about 0.2 to about 0.25%, right? And it was only here in December when Japanese bond yields really shot up. Okay, this was due to some central bank intervention. I forgot what it was by BOJ. Yes, okay, I remember now because the dollar yen had moved far too high, and because of certain requirements by the Bank of Japan, they had to strengthen the value of the yen. So when they strengthened the value of the yen, there was a big intervention by the Bank of Japan, and this intervention caused Japanese bond yields to spike. So when we had this spike in Japanese bond yields, that's when the yen also strengthened pretty considerably. Okay, so now what I will do is for the bottom chart, I will take the US 10-year bond yield minus the Japanese 10-year bond yield. So the good thing about TradingView is not only can you view the individual charts for bonds, for currencies, especially for bonds, you're able to do the yield differential as well. So just as simple as typing US 10Y minus JP 10Y will give us the yield differential between the United States and Japanese government bonds. So this bottom chart here is showing us the yield differential. And just to put things, and what we'll do, we'll change the top chart. Sorry, we'll change the top chart to dollar yen. Right. So as you can see, they are actually practically a mirror image of each other. So in a sense that if you wanted to know the direction of any currency pair, it will be good to look at the yield differential as well for that particular pair. So for dollar yen, you look at, of course, the US and Japanese 10-year bond yields. For Euro USD, you would do it similarly for European yields, or maybe the German and French 10-year yields versus the US 10. Aussie, same thing, you do Australian 10-year bond yields minus US 10-year bond yields. So by actually tracking the yield differentials together with inflation, right? You see where inflation is heading. Okay, you can see inflation has peaked. Right now I'm on the chart, on the BLS chart, where inflation has peaked and dropping. So as inflation is falling, this sets into gear, sets into motion that markets are expecting the Federal Reserve to be less hawkish. Although the Fed will still raise rates, but the hawkishness or the less hawkishness is actually displayed in the movement of bond yields. So that's why it is important to track bond yields, bond yield differentials together with inflation data, employment data, ISM reports as well as GDP, right? So once you have this few fundamental data points, right, it actually helps you paint the overarching picture of what currencies are doing, what bond yields are doing, and what central banks are doing. And basically, it gives us a relatively good idea of the state of the economy for each respective country. So as you can see, okay, so bottom chart here is the yield differential. So from the start of 2022, the yield differential between the United States and Japan was rising aggressively. Of course, there'll be pullbacks along the way, consolidation, range-bound period as well between here, May and August as well, right? But the dollar yen continued pushing all the way till 150, right? Look at it broke 150. Now, because of price, this movement in price, the BOJ had to intervene. There was a big intervention action by them, which led to Japanese bond yields to spike, despite uh, interest rates being kept at negative 0.1%. So the BOJ didn't alter their interest rates, but they actually intervened in the open market, right, by buying Japanese yen. And when they bought Japanese yen, the yields of Japanese bonds increase. So as this happened, as Japanese bonds yield on the Japanese bond increases and the yield on the dollar stays steady or starts to drop, you will see the yield differential start to fall. So if you are observing the yield differential, and paying attention to what the BOJ did with regards to their intervention policy, and looking at this DXY, and subsequently putting everything together, you will get a complete picture, or an overarching picture of why the dollar weakened, why the US 10-year yield dropped, why the Japanese 10-year yield increased, and then subsequently you would see the fall. You would understand the fall in the yield differential. You would understand the sharp pullback in dollar yen as well. So during this period, didn't matter whether Federal Reserve kept raising interest rates, or whether Fed's interest rates were at 4.755% and Japanese interest rates were at negative 0.1%. If you just look at interest rates differential, it's still in favor of the United States, but that's not reflected in the price of, or not the price, but that's not reflected in the yield on the bonds. It is not reflected in the strength of the dollar, and it's not reflected in the currency pair itself. So that is why it is important to look at about 4 or 5 fundamental indicators, and this will actually help you to paint uh, the larger picture, right? Because we are looking at weekly charts here. It helps you to paint the larger picture, help you determine turning points in currencies by looking at uh, central banks' action, looking at bond yield differentials, looking at inflation, and plus other information, right? You don't need to look at everything because there's simply too much, right? It's as a individual trader, or retail trader, right? There's so much info out there. So what do you look at, right? What do you focus on? So I would say look at what the big central banks are doing, look at where their interest rates are, look at where inflation is, look at where GDP and unemployment figures are, right? All this data comes out on a monthly basis. So it's not that something we need to track regularly, but then pay attention to the bond yield differentials, right? Because they will signal potential turning points in the currency pair. So that is why I like to use the dollar yen in this example, for to illustrate the importance of bond yield differentials, the importance of intervention by central banks, despite the respective interest rates still being very divergent, and to understand why certain moves in FX occurs, right? So once bond yields, the bond yield differential peaked and started heading lower in favor of the Japanese yen, the dollar yen also fell just significantly, right? And then it fell, yeah, from 150 to as low as 137. And then as the differential picked up again in favor of the United States, this was another turning point here, right, on a weekly chart. It didn't go lower. It actually formed a base here, and the yield differential started driving higher. So this would have been a clue to indicate that, okay, there's a potential change in direction, and we could expect the dollar yen to uh, retrace some of the losses that it has made. And likewise, again, as inflation expectations also continue to drop, with inflation uh, continuing to print lower, headline inflation and core inflation continuing to print lower, bond yields in US also started falling, and likewise this is reflected in the yield differential, and hence the dollar yen fell, right? Okay, so I think these are some of what I've covered is basically where to look for fundamental data, which are the key US fundamental data to look out for. And similarly, you could do that for other currency pairs, but that might be, frankly, that's probably a bit too much work, right? Just looking at the US alone takes up quite a fair bit of time for an individual person. So just maybe perhaps I would say concentrate on the US, right? Macro data. So look at GDP numbers, look at ISM numbers, and especially look at prices, because they will tell us where prices for the services and manufacturing sectors are heading. And this relates back to overall inflation. look at employment numbers, right? Look at how strong the labor market is in terms of total non-farm and in terms of how low the unemployment rate is. And also look at inflation, whether inflation is trending lower. Is it staying constant, consolidating, or is it starting to pick up again? And ultimately look at bond yields, right? The bond yield differential, right? So, are there any questions, or would you like me to revisit any particular topic or any uh, particular part of this webinar? Right. Okay. Otherwise, I can move on to something else, right? Something else that's coming up big today. So we have, as we've mentioned, we have the okay, let's just zoom in to yes, so of course. So today, 12th of April, 8:30 p.m. UTC +8, we have US inflation data being released. So this is going to drive a lot of the moves in FX and equities and gold later this evening. Well, in Singapore time or in Asia time would be evening, right? So in about 1 hour 40 minutes, right? Doesn't matter where you are, in 1 hour 40 minutes is where we will see a lot of big moves in currencies, currency pairs, in gold, and also in um, equities, right? So just as a quick, okay, so since we're talking about gold and inflation, okay, let me switch this to DXY. Okay, again, we are looking at weekly charts. So the top chart is showing us DXY, the dollar index. Bottom chart is showing us now gold. Okay, so let me get rid of volume. Okay, right. So since we are talking about inflation, uh, I think, and we have a big data point coming out this evening, right, or in a very short time. I think it's good to cover this as well. So what we're looking at now is the weekly chart. On the top, you have the dollar index. Bottom, you have gold. Okay, so similarly as 2022 began, uh, central banks started, the Federal Reserve started raising rates aggressively. Dollar index shot up, bond yields increased, and also uh, the geopolitical event occurred. Like, right, we had the invasion of Ukraine by Russia, so that created a big demand for gold as as a safe haven asset. So that drove up the price of gold in the first quarter of 2022. But what happens during this period also is it is important to note why. It's also something to take note. Why did um, gold fall after a major geopolitical event? You would think that investors, central banks would continue to buy gold and drive it higher. But actually, because we know that the strength of the dollar is inversely correlated to gold. So as the dollar increased, right, despite there being a major political event, geopolitical event, the strength of the dollar actually caused, is not the only reason, but it's one of the reason that caused this the price of gold to pull back very significantly. So this is also to do with combination of dollar strength and combination of what we call real yields. Okay, real yields are 10-year bond yields adjusted for inflation. Okay, so what that hap- what that- what that what has happened is, in this period when the gold peaked 2050, 2060, went down as low as 1600. During this period, real yields were actually rising. So when real yields rise, uh, together with the strength of the dollar, this negatively impacts the price of gold. But then the dollar index peaked in October, right? At the same time, gold bottomed And as the dollar pulled back significantly, and as interest rates, as inflation started to pull back as well, real yields turn more negative, right? I don't have a chart for real yields here, but just try and visualize it. So as real yields became more negative together with falling dollar, falling inflation, gold became a more attractive hedge against inflation. So what I'm trying to say is basically in this period, as dollar index strengthened, bond yields strengthened, gold is generally not a good hedge against inflation. Hence, that's why we saw the sell-off in gold. But after that, the macro picture changed, whereby the dollar index started falling aggressively. Inflation also started falling a little bit. Bond yields started falling, and in this environment, bond becomes a better hedge. Gold becomes a better hedge against inflation. Hence, we see the bid up in gold here from about 1600 all the way to almost breaching 2000 here in January. Then before pulling back again, because as the dollar rose, it pulled negatively impacted the price of gold. And also we had the banking scare here, right, in March. So in early March, we had the fallout from Silicon Valley Bank, Signature Bank in the US. Plus, we also had major issues in Switzerland, coming out of Switzerland as well, with UBS eventually having to take over Credit Suisse. So we've also had a banking crisis here, which sparked a drive uh, for gold as a safe haven asset. So as we see dollar index continue to fall, bond yields continue to fall, we may see gold stay elevated around this level. So which brings us to this um, uh, CPI event coming up. So if CPI, so there's several factors to look at CPI. You've got headline CPI, which contains all the components, and you've got core CPI, which doesn't include food and energy. So they'll be looking at uh, the monthly growth of headline and core CPI. They'll also be looking at annualized growth or the year-over-year growth of headline and core CPI. So if these data points, there are four major data points to look at. So if as a whole they all uh, print softer than their estimates, that means they come in lower than all their estimates on a monthly basis, on an annualized basis, and also compared to the previous month, it is very likely that bond yields will drop, the dollar index will drop, and this would potentially create another tailwind for gold. Conversely, if inflation comes in hotter than expected across all uh, four metrics, then it's very likely that bond yields will rise. Dollar index may rise as well, but if bond yields rise aggressively, this would potentially cap any further gains on gold and may drive it lower, right? Okay, so not only have we covered fundamental strategies for forex, we've also looked at a bit of gold because it all interrelates with each other, right? You look at forex currency pairs, you look at bond yields, you look at inflation, you look at dollar index, the strength of the dollar, the weakness of the dollar. You look at bond yield differentials, use the 10-year bond yields and the differential between the countries to see where um, price is headed, where the major turning points, where the major inflection points, and look out for central bank announcements, what they are doing. And yeah, this would help you picture the big, piece everything together to form a large picture. And then once you have it, once you know what the overarching uh, theme is or the environment is, you are able to scale down into daily charts, 4-hourly charts, and hourly charts. So what I've presented here is mostly through weekly charts. So at least we are able to understand the trends, the longer term trends, and also potential turning points, right? Okay, so um, I've come to the end of today's webinar. I hope this has been a good session for everyone. And if there are any questions, feel free feel free to fire away in the chat. And yeah, I'll stick around for, I guess, a minute or two. And if you have any questions, please let me know, whether it's something about CPI today or if it's something about what we've discussed recently. I mean, discuss in this session, or would you like to clarify any other points or any other topics? Wait, sorry. Ah, sorry. Okay, the Harvard. Okay, there's a question I missed. Completely missed this. Okay, sorry. Okay. On the day of this release of manufacturing PMI data, does the dollar move the same way? No. Okay, wait. I'll type the answer. Okay, so basically, I'll type the answer to Howard and also explain it live as well. Okay. His question is, on the day of the release of manufacturing PMI, does the dollar move the same way the NFP data moves the data? Okay. So generally speaking, PMI numbers are important, but they don't have that much of a significant move in currency markets. I mean, it will drive sort of the longer term movement, but on the day of release, it's not as impactful as NFP. NFP data releases tend to have more, or not tend, they create more volatile instances rather than PMI releases, right? So I think that's yeah, different. That's something to understand as well. So different news events have greater significance and introduce higher volatility than others. Okay, so also just type the answer as okay. I'll just answer it. I've already answered it. Yep. Okay, then just- right. Okay then. All right. Okay. Yeah, okay. So I've come to the end of the webinar. So yes, so I hope you guys have found this useful. And remember, it's about trying to understand the big picture so that we can scale down and zoom down into your particular your favorite time frame, and then you are able to uh, identify trading opportunities, be it on the short or long side, and then try to successfully create high probability trades and trade outcomes for yourself. All right. Okay. Thank you, everyone, and yeah, have a good trading week. All right. Take care, guys and ladies and gents. All right. Bye.